Liability. What was the liability? Liability is current obligation at the present time of the corporation, which has to be settled in the future and exists because of the past event. So the interesting thing with the liability has the whole dimension of time. You have present, we have future, we have past. Past, something happened. Presently, we have obligation to pay it when in the future. Settlement is in the future date. If that was settled in the past, currently we won't have obligation. So there will be no liability. That's what I want you to understand. In order to have a liability at the reporting date, the company has to owe something to somebody because something happened in the past. If that doesn't exist, then it's not liability. Now, why people owe money? For many reasons. What kind of liability we're going to have? We're going to have a current liability. We're going to have a long-term liability. Which one is the current liability? Remember it, the same thing as the current assets. Whichever is longer than current operating cycle of the company or calendar year, whichever is longer. Either 1 year, either operating cycle of the company, whichever is longer. That's how we settle, that's how we define the current liability. What if it's not current liability? Then it's long-term liability. We only do the test for the current liability. We always going to represent whichever is owned by the company within the next 12 months or operating cycle from the reporting date, starting from the reporting date. And whichever falls beyond that period, that will be a long-term liability. Why are we having liabilities? First, because we might have purchased inventory, but we forgot to pay, which payment has to happen later. Now, as you can see on the liability, on those kind of liability, there's no interest. So this can be considered even free borrowing. Then we're going to liability because we borrow money. Once we borrow money, obviously we have to pay interest. Now, for what reason we borrow money, that's a different story. Is it because we bought inventory we haven't paid yet and we issue not payable? Either because we borrow money and we have to pay the loan outstanding, that's another story. Now, I want to make it clear for you. I'm going to talk about this next time as well and remind you next time for the midterm. The only thing that I'm purposely choosing the questions which you have to calculate interest based on the month, not based on days. Day calculation is not going to be included in your midterm, just to avoid any confusion with which day we're borrowing, which one I'm paying, and all those things. It's going to stay with the month on the monthly basis. So what you have to do, interest is always quoted on annual basis, check the number of months, and do the calculation. Even if you borrow on the first day of the month, count the whole month. That's how it's going to be on your midterm. Now, on this case, remember that when you borrow the money and you have reporting period between the borrowing and the payment, on the reporting period, you have to show the liability for the period on which you owe interest. You owe interest because you haven't paid it yet. So the fact that you haven't paid it, it doesn't change the fact that you owe the interest. So you have to show on the reporting date interest payable. Debit interest expenses, credit interest payable. Interest payable is going to go to your balance sheet as a current liability. Interest expense is going to go to the income statement as a operating expenses. On the day that you have to pay the interest, don't forget to show the interest expense for the remaining period from the reporting date to the payment date. Close the notes payable by clearing the outstanding notes payable. close the interest payable, which you created on the reporting date, and settle everything in cash. So for the line of credit, already we did this exercise last time, but again, I'm purposely chasing questions which the dates are not involved. Only the period that the shortest period that you have to use is months. So use full amount of months, not half month, not quarter of the month, the entire month. So the next thing why we owe you money is because there's a transaction, and based on those transactions, we getting into involvement with business with Canada revenue. Which one will be that? That will be related to the goods and sales taxes and provincial sales taxes, and in some instances, harmonized sales taxes. So what's we gonna do with this? There will be question. So there will be question on the goods sales taxes. I want you to know how to deal with this. So basically, either you purchase, either you're selling, you always have to charge 5%. Now, when you're buying the merchandising or the equipment or any goods, you have to pay 5%. When you selling, your client has to pay you 5%. The one that you're paying will be GST recoverable, which means you have to get it back from the government. The one that you're charging to the client and client pays you will be GST payable. So what's going to happen at the end of the period? At the end of the period, you're going to check how much government has to pay you, how much you have to pay. Closing the recoverable, since the recoverable has debit balance, closing on the credit side. GST payable, closing on the debit side, since you already created a credit balance. Clear the difference with cash. Move on. Harmonized taxes, same thing, but again, for the purpose of midterm, I'm not going to chase harmonized taxes. I'll deal with the GST. On the provincial taxes, there might be a question on the provincial taxes, but the provincial taxes, remember, you just have to submit it to the government and nothing more. You're not asking for the provincial sales taxes back. There's no recovery there, only payables. We're going then to the current portion of long-term debt. Current portion of the long-term debt. If you have a long-term debt, which is more than one period, let's say you owe this company borrowed $7,500 on January 1st, 2014, which has to be repaid every year in the installments 1,500 over the next 5 years. So if you're here on December 31st, 2013, the first amount that we have to pay on January 1st, that will be our current liability. The remaining amount of $6,000 will be long-term liability. Then on December 31st, 2015, the amount that we have to pay on January 1st, 2016 will be our current liability. The remaining 4,500 will be long-term disability, long-term liability. And keep going, keep going, keep going. We have to accrue expenses. Why? Because we owe money. Why? Because something happened in the past in which we haven't paid yet. What we haven't paid yet? Either we haven't paid the salary for our employees, either we haven't paid interest on the notes payable or the bank loan, either we haven't paid yet property taxes. All those gonna trigger payables. That means we have to do debit expenses, credit liabilities. On the payroll, stub pay period happen when the period falls at the middle of the pay period. Reporting period happen when we have a reporting date between the payments. On earned revenue, what's the unearned revenue? Unearned revenue is money received for which we haven't delivered the services yet. So temporarily, they're going to stay as a deferred revenue until service is performed or the goods are delivered. How we deal with this unearned revenue? Again, we're receiving the cash. We already received the cash. Later on, we have to start performing the services. Let's see, this is the subscription, which subscription we pay $20. So the person, in this case, the company that have to send on the flyers or whatever that we subscribe to, they get the cash. For them, that's a non-revenue until they provide the services. Once the first month pass, if it's for 4 months, $5, we have to recognize the $5. What's this? So that's how that one. What if the customer give you deposit? Now, if the customer give you deposit, that technically is not your money until the certain conditions are met. Now we're going to the liability which has to be estimated. In other words, you have to show the provision for those liability. Which one is that? The estimated warranty payables. There will be question on the midterm on the warranty. So far, questions on the GST, question on the warranty from this chapter. Warranty. What's interesting with the warranty? We showing the warranty at the same time when the revenue is recorded. Why? Because if there's no revenue, there will be no warranty. Warranty goes together, is attached to the revenue. Once you sell the laptop, warranty goes with the laptop. Once you sell the watch, the warranty goes with the watch. So the warranty is going to reduce your revenue. It's called provision. We provide you make a provision for some expenses that might happen in the future, which haven't happened yet. So the example that we saw here is this company providing 1 year warranty and the company estimating that 1% of all the sales is appropriate basis for the estimation for the cost of the warranty that they expect to pay over this 1 year for all the sales that they're making for $80 million. So what will be the journal entry? Journal entry, obviously, we're going to recognize the revenue. And we're going to show accounts receivable, $80 million, debit accounts receivable, create $80 million for the sales on account. And then right there, we're going to show the warranty expenses, which is our provision for something that we expect to happen in the future. And since it hasn't happened yet, since we haven't paid those one, it's going to show it as a estimated warranty payable. As you can see, it's not actual, it's the estimated payable. What we're going to use with that estimated payable. So now every time when the actual warranty happen, which is related to the sales of all those $80 million, we're going to start reducing the warranty payable on the debit side, and either we have to pay cash, either we have to replace items from our inventory, regardless which one. But you're always going to reduce the liability for the warranty payable, and you're always going to reduce asset. Which asset is going to be cash or inventory? That will be depends on the question. Same thing we have to do with the vacation that we owe to our employee. Employee, as you know, they're working during the year. Some of them using their vacation, some of them not. For those who haven't used their vacation, means at the end of the year, we owe them money for their vacation. So what we're gonna do then? We're gonna show the liability, and we're gonna, on the debit side, we're gonna create a vacation payable expense. Once the actual vacation is taken, we're not gonna show expense again. We're only gonna show, we're gonna start reducing our estimated vacation payable liability. Same idea with the income taxes. If you remember from last time, I told you that corporation pay income taxes and income taxes on the year where they start generating income. If they're not, obviously, the first year of operation, since there's no previous year information, the corporation doesn't know installments. If the first year of operation company incur loss, net loss instead of income, second year corporation doesn't have to do installments. But once the corporation generate income and start paying taxes, Canada Revenue wants to make sure that you pay them at least the taxes that you paid last year as installments over the 12 months of your operation for the next year. Now, let's pretend that this company is required to pay taxes and to make installments during the year based on the estimated tax for 1 year, or based on the taxes that they pay last year. And they estimated that they have to pay every month. They have to pay $100,000. By the end of the year, they payments that they made towards the installments, it's already $1.2 million. Now the question is, if they already pay $1.2 million, what's the actual taxes that they have to pay? And since the actual taxes that they have to pay are not known until the end of the fiscal year, once the accountants do the calculation, which will be the accountants, some of you in the classroom. So those are people who are doing business gonna come to you and gonna ask, hey, can you do my taxes? Obviously, you're gonna say yes. And since I know you from the class, I'm gonna give you a small discount. And how many installments you made during the year? I made installments for $1.2 million. Okay. Based on the calculation here, your actual taxes are for the amount of $1,240,000. After we deduct the $1.2 million installments that you have made, you still owe the government $40,000. And that will be your only income tax expense at this point, because we already recorded $1.2 million into income tax expenses through the installments that we're making every month. So we just have to add the $40,000 to match the actual tax expense for the year. And that's going to go for the income tax payable. And when we have to pay this, Canada Revenue wanted pretty much right away. So basically, by January 31st, not by January 31st, depends on the type of corporation. If it's publicly traded corporation or not publicly traded corporation, you have, so how was it? Just a second. For the publicly traded corporation, you have 2 months to pay your taxes. But if you're a private corporation, you have 3 months to pay your taxes. That's where we finished last time. We finished on the income tax payable. That's why I highlighted with red. So that can remind me that this is the point that we finished last time. So now we can catch up with the current stuff. First one is the contingent liability. What's contingency? Contingency is that which something which may happen, may not. And since there are so many conditions that has to be met, contingent liability is defined as a potential liability that depends on the future event. Again, happened because something happened in the past. Future event is the court case that might be settled in the lawsuit. Now, the contingent loss, since it hasn't happened yet, but we expect to happen, it has to be accrued and show as a liability. Usually the user financial statements, they want to know, is there any potential liabilities for this company before I purchase the shares of this company or before I become owner for this company? That's for the losses. So everybody wants to see the losses. How about contingent gain? Contingent gain, we never show it. We never recognize contingent gain. Not until you actually is realized. What mean realized? Means that we get the money. I want you to understand this and want you to, for the people who's going to continue with the accounting, to remember it and put it somewhere in your brain. And when it comes to the CPA, you just to keep it in mind. We only and only recording contingent liability, possible liabilities. We never recording possible gains. Even if you know that the gain is gonna happen, even if you're 100% that the gain is gonna happen, you're not recording it until you get the cash. Where in the liability is a different story. Even if you have a slightly doubt that there might be a liability on the International Financial Reporting Standards, you have to show it as a liability. How are we gonna call this? I mean, isn't that like looks like we measuring the same thing, but with double standards? No, it's not. That's called, as you can see later in accounting, with those gonna go with deeper in accounting, that's called conservatism. We are concerned about the event that's gonna happen against the company, and we recognizing the events that gonna happen in favor of the company only and only when they actually happen. We're trying to protect the investors and creators for the potential impact of the negative situations, not to show them the possibility of the positive situation. So let's see how we're gonna measure this level of the certainty. First one, level of certainty is likely to happen. Then we're asking ourselves, okay, if it's likely to happen, can I measure it? Can I estimate it? If the answer is it's likely to happen, yes. Can I measure it? Yes. Then I have to show it as a liability and show it as expense. Debit expense, credit liability. Second option, is it likely? Yes, it is likely. Can I measure it? No, I cannot. Then we have to disclose it on the note of financial statements. Third option, what's the certainty of happening? Is it likely or unlikely? Very unlikely. Can I measure it? Yes, I can measure it. If I can measure it, but it's most likely not to happen, then we have to disclose it. Now, again, fourth situation is it going to happen? No. Very unlikely to happen. Can I measure it? Absolutely not. Then what we have to do? Nothing. You just do nothing. Why are you doing nothing? For the people who's going to continue the counting, please copy this one for yourself and keep it somewhere. Because later on, you're going to see what's the difference, because this is under accounting standards for the private enterprises. And later on, you're going to see what's the difference between these standards, accounting standard for the private enterprises, and international financial reporting standards. I'm not going to tell you now. Once you get the new teacher for that course, you're going to see the differences. If you cannot see the differences, come and find me. I'm going to show the differences at that point. Now obviously, if you cannot determine, if you cannot be determined, then you have to disclose it. Let's see what you think about this. I think you're saying something in the chat room. Let me see what you're saying. Yeah, A. Yes, A is the right answer. Okay, now what's the ethical issue with these things? Ethical issue is the business want to look as successful as possible. And sometimes I know the information, I know there's a liability, I know I can measure it, but I decide to close my eyes. I'm not even showing it on the notes of the financial statements. So we have to be careful with between the disclosing and giving away too much information. Which direction you're gonna go? Can I disclose it? How much information I can disclose? The other thing that you have to keep in mind is if you make mistake once, then the reputation of the business goes down. And the few people, I mean, you make a mistake once, and the people actually found that you actually make mistake, then that's gonna ruin the company's reputation. There may be other consequences. Let's not go that. Now, the next thing that you're gonna have question on your midterm exam is payroll. Definitely you're gonna have questions on the payroll because I want you to understand how the payroll is calculated so you can actually use it for your own purposes one day. And if somebody asks you, can you do a payroll? At least you can say with confidence, yes, I can do a payroll. Every company needs somebody who can do their payroll, otherwise their employee is going to start complaining. So there are numerous ways to express the employee gross payroll. We can express it as a salary, we can express it as a wage, you can express a commission, it can be piecework, it can be bonus, it can be benefits. Salary, a monthly, annual, weekly. Wages, usually hourly rate. Do you know how to move from salary to wages and from wages to the salary? If you say no, I'm going to explain. If you say yes, I'm going to move on. No. So, okay, let's say somebody tells you you're going to for work. So, you're going for the job interview and they say you, okay, the annual salary that we're planning to give you is $70,000. Now, $70,000 is your annual salary. The question is, what's my wage? You're going home and somebody asks you, well, how much you going to get per hour? I don't know. They're going to pay me $70,000. How can you move from the salary into wage? Very simple. Ask them, how many hours you have to work per day? If they tell you 7.5 hours per day, now 7.5 hours for the entire year, that's going to give you 1,950 hours. I already told this to some of the people here today. Or if they tell you you have to work 8 hours per day, that's going to transfer to 2,080 hours per year. And at this point, what you have to do, well, do the math. 70,000 divided by, if you're working 7.5 hours, divided by 1,950, and you're gonna get that your wage is exactly, let's see, how much is this? 70,123 divided by 1,950. You're getting almost $36, 35.89. That's your wage. Now, the other option is if you work 8 hours, obviously that rate's going to go down because you're going to have 70,000, still 70,000 divided by 22,080. And then you're going to get that that's 70,000 divided by 2080. That's going to be 3365. What is your opportunity here for the accounting people? Opportunity here if you pay by wage, if you pay hourly. If you pay hourly, let's say hourly, if you're paid, let's say $36 per hour, and then you're going to start doing calculation. What will be that will be per hour. What will be how much will be my income at the end of the year based on 36? Well, it depends how many hours you work per day. How many hours do you think accountants work per year? Are they working 1,950 or they're working 2,080 hours? Give me your projection. That's a very good number. However, they usually work more. It's very common. It is very common at the end of the year, accountant to end up with 2,200 hours. So now the question is, how that transfers the income? Well, if you have 2,200 hours times 36 hours, that's transferred to 79,200 per hour, which is completely different than if you work, if you're on the salary for $70,000. Correct? So you as an accountant have more incentive to work and to be paid on hourly base rather than salary. Because if you're on the salary, the employer always going to push you to work more than 2,080 hours, which is covered by the 70,000. Now, if that happens, you have to remind your employer about the BC Employment Standard Act, which BC Employment Standard Act says that every hours on the weekly basis or a pay period over 80 hours, the employer owes you overtime, which is 1.5, unless you're a CPA student. If that's happened, tell you what to do. So that's with that calculation. That was some extra for you. So now let's go with the other option. The other option is commission. Instead of paying salary and wage, you paid commission. Commission based on the sales that you're generating. Or bonus, which is above an average of the base salary. Now let's see how we're gonna deal with the payroll. Payroll first. We're gonna have a normal time, which is the straight time, which is pay for every hour you pay the rate that you have to rate the employee based on the number of hours, up to, again, as we said, 40 hours per week or 80 hours per pay period. Everything over those hours are considered overtime, which has to be paid 1.5 times of the straight time rate. That will be considered your gross pay. Gross pay is the money. What's the difference now between the gross pay and the net pay? Gross pay is the amount of money that you want, the amount of money that you like, but the amount of money that you're never gonna get. What's the difference between gross and net? Net is the amount that you don't like. and you don't want, but that's the only one that you're gonna get. That's how you should put it in your head. Gross is bigger number, net is the lower number. What's in gross? Everything that you earn. What's in the net? Everything that you earn, less all the money than that the other people want to take away from you in form of deductions. What are those deductions? We have to check the payroll deductions. Payroll deductions are many. You have statutory deductions, which are required, or that means there's no option for you to avoid, and you have optional deductions, which are you may opt to use it or may not have options to use those. What will be the required? The required are first income tax. Employee income tax. Every employee has to pay income taxes at the time when they earn their salary. Not because they owe the taxes, because that's gonna be considered as an installment towards the taxes that you have to pay at the end of the year or next year when you do the tax return. You might end up not paying taxes, don't have to pay taxes. Then whatever taxes, employee income taxes was deducted, it's going to be returned back to the employer, if that's the case. Second thing you have to pay employment insurance. EI is equal to the employment insurance. The last thing is Canada pension plan. And those are the statutory payroll deductions. Which are the optional? Optional include, but are not limited to, union dues, insurance payments, charitable donation, and can be other. Now we're going to the employee payroll cost. How much employer, what's the expenses for the employer? The expense for the employer is, first, gross payroll. Second, employer has to match employee contribution to Canada Pension Plan. If the employee contribute $1, employer also have to contribute $1. What's the current percentage? Let's see. How we can see that? I'll show you right away. Let's not waste time. Let me show you right away. What's the current deduction what's the current rate for the Canada Pension Plan? Where we can find this? CRA payroll deductions, always online calculator. We're gonna come to that one later, but let's say payroll Canada Pension Plan deductions. Once you click here, it's gonna give you the Canada Pension Plan contribution rate maximum and exempts. So, in the beginning of January 2024, deducted secondary, the Canada Pension Plan start deducting second additional Canada Pension Plan contribution on top of the regular contribution. What is the regular? What is the second? First one, second. Now, in 2025, for every dollar that you're generating as an income, you owe 5.95% for Canada Pension Plan. Now, when you're making your income, the first $3,500 will be deducted. From the first $3,500, you don't owe Canada Pension Plan. How is that going to be calculated? Let's say this month you're generating $1,000, which will be your, let's say on the 15th of January, you're generating $1,000, which will be semi-monthly salary payment. At that point, we have to do the calculation. If the employee earned $1,000 and the employee is semi-monthly, what will be the amount if we pay the same $1,000 over the remaining payroll period, which will be for the entire year or the next 24 periods? How much will be the total income for that employee? Obviously, 1,000 times the remaining periods, which is 24, which would be $24,000. On the $24,000, we're going to deduct $3,500. We're going to prorate it. We're going to calculate the Canada Pension Plan, and then we're going to calculate how much is the portion that the employee has to pay. We're going to do this calculation in a second, so you're going to see how that works. But that's the general idea. You're paying Canada Pension Plan up to income $71,300. Once you reach $71,300, you stop paying Canada Pension Plan on the basic rate of 3.95%. What's going to happen if your income go over 71,300? Then you're going to start paying the second Canada Pension Plan, which is right here. So what that means is from 71,300 up to 81,200 for the next $10,000, you have to pay 4%, which transfers to $396. Employer also have to pay $396. The interesting thing with the Canada Pension Plan is whatever the employee contributes, the same thing the employer has to contribute. That's why the total is doubled. The maximum is doubled. Because whatever employee contributing, the same amount the employer has to contribute. That's for the Canada Pension Plan. Now let's check what's happened with the employment insurance. Deduction, payroll deductions, employment insurance. The employment insurance payment is, let's see, where is the calculation, deduction of the employment payroll. Let's go with this deduction table. Let's see if the deduction table is here somewhere. It is here for the 2025, for the current year. Every employee, for every dollar that they earn, they owe 1.64%, or 1.64 cents for every dollar that you earn. So the maximum contribution that you can do for the year is $1,077.48, and that's based on the maximum earning of $65,700. What if you earn more than $65,700? The employment contribution stops. That will be the employment insurance stops. No more. Now, what's the difference? The difference is the Canada Pension Plan is going to start when you reach $81,200. That's where you're going to stop, because up to $71,300, you have to pay 5.95%. For the remaining 9,900, you have to pay 4%, which 9,900 times 4% is equal to $396. And after that, for every dollar after 81,200, you're not paying. Those are the Canada pension plan and employment insurance. What's going to happen now? So what we can take from here is on the slides, we can adjust the rate for the employment insurance. And it's not 1.63. That's still the same rate for 2025 plus 4% additional between 81,200 and no, that will be 71,300 and $81,200. That will be the current legislation, and then we can update the slides. And here the rate is 1.64%, and that will be for 2025. Make adjustment for your slides as well. Now, 1.64 is the portion of the every single employee. How about the employer? Because now we're chasing the employer deduction. Employer has to contribute for every dollar that the employee contributes, the employer has to contribute 1.5, $1.40. If the employee contribute $1, the employer has to contribute $1.40. That's how you should remember it. Is there any options the employer to avoid that 1.4%, 1.4 times employee contribution? The very, 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 very slim chances to do that. There's some eligibility for that, but that's not the point here. The point is that for all the questions that you have to do in this course, you have to calculate the employment insurance for the employee, and then you get 1.4 for the employer. The last thing is the employer's compensation premium, which is due only by the employer based on each province times the employer gross payroll. So the disbursements. Now those numbers might not be accurate and might not be reflect exactly the amount, but what we can do is if the gross pay is 2,000, we can easily calculate what's happening now. How we can do that? I'll show you how you can do this. Again, for accounting people, please make yourself a note. For the rest of you, you can use this as a tool to check your employer and to check your payroll if you want to do that. So what we have to do, if you remember, when we go CRA payroll, and there was one payroll calculator. Go with the payroll calculator now, and you're gonna see payroll deduction online calculator. Once you see use the calculator, click yes. And then ask you for what kind of earnings you have. Do you have a salary? Do you have a commission? Do you have a pension? Do you have kind of the pension plan, whatever you have? Let's stay with the salary. We are salary. Let's click on salary. Here it's going to ask you for the company name, employee name, and employer name. Next thing we have to choose is the province. Choose the actual province. Payroll period frequency, and then you can see how many options you have for the payroll. You can be paid daily, you can be paid weekly, you can be paid bi-weekly, you can be paid semi-monthly, you can be paid monthly, you can be 10 periods per year, 13 periods, 22 periods, weekly 33, bi-weekly 27, so many options for payroll. Now in our example here, we're paying gross $2,000. Let's stay with, let's pretend the employee here is, we're paying 26. per year, which is bi-weekly. The employee gets every other Friday, gets paid. Next payroll period most likely will be 2025 definitely. Believe it should be if the last Friday was your payroll, third, the next payroll will be on. Sorry, last Friday was 31st, January 31st. The next payroll will be February 14th. So let's go with the next. We said we want to pay this individual $2,000. Let's pay the $2,000. Nothing else. No bonus payment, no retroactive payment, nothing like that. Taxable benefits and allowances, no taxable benefits, no tax deductions, nothing. It's not part of the Quebec pension plan. It's not member of the clergy, whatever that is. Click next. So now, ask you for the personal tax credits. We're gonna leave the maximum available tax credits for this employee. Number of the pensionable months will be 12. This is the important part here, because those number of the pensionable month is going to count for the calculation for the deduction of the $3,500 that you have of the monthly, the annual exempt from the income. But let's leave it 12. Let's pretend that this employee is going to work for the next 12 months, 12 pensionable months. Employee insurance, employment insurance is up to date. The employment is not exempt. The employee is not exempt. You just have to pay it. Now, you may put here, if this is not your first payroll, so that's the tricky part here, is that you can check this on the first payroll, or you can check your employer on the later payrolls. What you have to do is you have to see your last paycheck, and if you already been deducted Canada Pension Plan and employment insurance, you can put it right here. And that's going to change the calculation. So for the employer, he pays employment insurance 1.4 times the employee premium. So that's from the slides. It's not just a made up number. It's come from the Canada Revenue. So let's calculate and see what's going to happen. If this employee earned $2,000, employee owes, we have to deduct from the $2,000. We have to deduct $176.89 for the federal taxes, $71.03 for the provincial taxes. Total deduction for the income tax is $247.92. Then we have to deduct $110.99 for the Canada Pension Plan. Then we have to deduct $32.80 for the employment insurance. Total deductions will be an amount of $391.71. So the employee is going to see in his bank account $1,608.29. What we're going to do with the $391 that we're going to take from the $2,000 that we have to pay the employee? Well, those amounts, that's $391 plus something else. Let's see what will be else. Let's keep going and we'll see the calculation. Let's go with the next calculation here. Is going to be next calculation, or that will be next calculation for the employee. Let's go back. Sorry, I made a mistake here. Let's calculate it. It's going to show me the same thing, salary 2,000. Let's quickly fix this one. Everything is the same. Boom, we come up with the, no, that's too much now. Yes, because I moved to the next calculation. Let's go with the previous 2,000. Next, calculate. No, still no. Our numbers was different, wasn't it? Let's start again. I made a mistake here. Let's start again. Let's do it very quickly. Province again is British Columbia. Next pay, we're gonna pay the employee February 14th, we said. That will be bi-weekly, 26. Next. For the period, $2,000 and $2,000 only. Next. Same, all the deductions gonna stay the same, and we're gonna get the amount that we get before, 1,608.29. This is if this is the first payroll for the year. That's why you have here the next calculation what's gonna happen with the next calculation? The next calculation is gonna add those cumulative amounts and see what's gonna happen. Now, but that's not the point. The point is employer, once deduct those amounts, the employer owes to the government 391.71. Is this the only money that the employer owes? No. What else the employer owes? Well, if you go here, the employer submit a remittance summary, it's gonna show you. Now, employer, what the employer owes. Employee owes 110.99. Employer owes Canada Pension Plan same amount. In total, the employer has to give to the government 221.98. For the employment insurance, employee owes 32.80, which we deduct from the payroll. Employer owes 32.80 times 1.4 or 45.92, which totals 78.72. Plus, the employer has to pay the remit to Canada Revenue the federal taxes, which were deducted from the employee. So in total, the employer has to submit to the Canada Revenue $548.62. So the question is, what's the employer cost to have this employee and to pay the employee $2,000? Obviously, the cost will be the $2,000 plus 110, which is the employer Canada Pension Plus contribution portion, plus employment insurance, which is the employer employment insurance contribution portion. So the cost of the employer is not 2,000, but is 2,000 plus the Canada Pension Plan employment employer contributions. Make sense? I spent too much time on these calculations. I hope you understand it, and I hope one day you can use this calculator. You won't be the only one who's using this calculator. It's very good checkpoint for you to see where you are and to see what kind of contribution the employer has to make. You can view the combined results in PDF. You can see the PDF. There's so many different. You can go and modify the calculation. You can start with the next calculation, which is from the different employee, or you can start over. Depends what you want. Now the question is, probably the biggest question is, what if the employee makes instead of $2,000, employee make $1 million? If let's say magically the employee earn this pay period $1 million, how much do you think the employee is gonna walk away with? More than 500,000 or less than 500,000? Somebody says more. Any other suggestions? Let's see. Let's see. Magically, we made up this month $1 million. Let's see what's going to happen. We're going to keep all the basic deductions, nothing extra, nothing. And when we calculate, let's see what's going to happen. So we make the $1 million. Then from those $1 million, there are going to be deduction for 328,559.23 for federal taxes. So we're not going to see 328. That's going to go to the federal people. Provincial people is going to get 203,864. That will be total 532,422 in taxes. So for every dollar that we're making, we're going to pay 53.24% taxes. That's income tax. After that, we have to pay for the Canada pension plans $4,043. Then we have to pay the extra $396 since our income is over 1,300. And we have to pay employment insurance for 1,077. So our total deductions are 53,700, 53, 537,931.15 cents. So for every dollar that we're making, our deductions are 53.8%. So what can we enjoy? We can enjoy the rest. So from $1 million, you're gonna see only $462,068, which represents 46.2% for the every dollar that you earn. How do you like it? How do you like the idea to you to earn money and then to get less than 50%? So this is in British Columbia, right? That's what we have to do. This is the British Columbia. Let's check what's going to happen if we change the province. Let's pretend we move to from British Columbia. Let's move and live in where? Let's go to Newfoundland and Labrador. Or Quebec will be. So let's go to Newfoundland and Labrador. Sounds like an interesting province. Let's see what's going to happen there. So in British Columbia, we're taking 46.2%. If we go into Newfoundland and Labrador, we're going to get 44.9%. We're getting a little bit higher. Why? Because the provincial tax is going down. The federal tax is always going to be the same. And all the Canada pension plan and employment insurance is going to be the same. The provincial tax is going to be, actually, here is lower. In BC, we're getting 46.2. Here we're getting 40, less than 45%, 44.9. Sorry, in Newfoundland and Labrador, they're going to tax us more. Let's see where we're going to be if we go to Alberta. If magically we move to Alberta, making the same $1 million, oh, we're going to get more than 50%. So if you wonder why people are moving to Alberta, maybe there's a reason for that. Let's see Quebec. Somebody wants to see Quebec. Let's go and see Quebec, where we are, if we are in Quebec. Where's Quebec? Right here. The question is that true? Let's see if I'm missing here something. Let's go on the check, the previous check on the very start. Let's accept this one and salary. Let's start with the salary next. And here, and let's go with the Quebec. Let's double check this just to make sure that we're on the right track. Month February, that's January. Let's go with February, and the day is 14th. Next, we say 1 million. Taxable benefit allowance, we're not going to check anything here. Canada pension plan, other deductions, union dues, no, 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 no. In 20, or contributed to CPP, including before transfer to Quebec, member of the clergy. No, there's nothing here. Canada pension plan. In the employee contributed to CPP, including a second additional payment, if the applicable before transfer to province of Quebec. No. So let's go next. Let's go no. Let's go next. Yeah. Quebec pension plan, secondary additional, and Quebec exempt, no. Quebec pension plan, additional year to date. Let's go with this one. Number of months, exempt. Quebec, no, we're not exempt. Insurable earning. Let's go with year to date. Let's go, we stay with this one. Nothing else. Yeah, still the same. I guess province of Quebec doesn't charge provincial taxes. And as you can see, the employment insurance is way lower. So what's the takeout here? Starts learning French. That's with the payroll calculator. So now you can know how to calculate the payroll. And taxes, let's go to our example here. Now here we can make some adjustments and based on where we are, what's happening here on those numbers. Which I'm not going to make the numbers, but not make any adjustments because those are the pictures which I don't have access. I cannot log in. Anyway, let's go with the payroll entries. How are we going to do the payroll entries? The payroll entries will be the one that I'm going to test you. I'm telling you, I'm going to test you on the midterm on the payroll entries because I want you to know those entries. First entry will be to record the employee deductions. Second one, we're going to do the employer deductions. And then we're going to do the payments. So if the employee generates salary, total salary expenses as 60,000, then the income taxes, we have to deduct income tax payable from the salary expenses or from the money that we're paying for the employee. We have to deduct Canada pension plan payable, employment insurance payable, union dues for that employee, and we're going to pay the difference. We're going to put it for time being for the salary payables. So as you can see, we're matching the expenses with the payables, all payables. After that, we're going to do another expense, which is the employee benefit expenses. And that employee benefit expenses will be for the employer portion for the Canada pension plan, which will be exactly the same. If the employee contributes 2,970, employer has to contribute exactly the same amount. And if the employee contributing 1.120 for the employment insurance, the employer has to contribute 1.120 times 1.4. So now this Canada pension plan payable plus this Canada pension plan payable is going to give us the total money that we have to pay to Canada pension plan. This employment insurance payable plus this employment insurance payable is going to give us how much we have to pay to employment insurance. So how are we going to do it? First, we're going to pay also, this employee has benefits for the dental or any benefits, employee dental benefits. That will be expense for us, payable for us as well. And workers' compensation, we have to accrue the workers' compensation if there's workers' compensation. And after that, we start paying cash. First, we're going to pay all the payables. Employee income tax payable, which is purely and only related to the employee. Then we're going to pay Canada pension plan for the employee portion, employment insurance for the employee portion, Canada pension plan payable employer portion, that will be employee here. This one will be employer portion, that will be employee here. That will be employer portion, and we pay everything cash. That will be the first payment that we have to send to the receiver general. That's how we pay payments to the Canada Revenue. Then the union dues, we have to pay it to the association to which the employee owns the union dues. Then we have to pay for the medical dental to the insurance company. And for the workers' compensation, we have to pay it directly to the workers' compensation people, which, as you can see here, we're not dealing here with the Canada Revenue anymore. With Canada Revenue, we're dealing only for the employee income taxes payable, Canada pension plan, and employment insurance. That's all. That if you are employee. What if you are self-employed? Well, the company can pay to people who are not employee. Those independent contractor, they have to give you the invoice, and they're treated similar like external vendors. We just pay the invoice and that's what. So, how are we going to report the payroll and other liability on the balance sheet? In order to do that, we have to have this payroll register. We have to issue the payroll checks, and we have to keep employee records. Once we have all those things, we're going to say that we have a payroll system in place. So again, for the payroll system, the components are payroll register, payroll checks, employee earning records. First, company, we're going to organize all the information. List of the payroll data for each employee, what's the date of birth, what's the social insurance number, what's the address of the employee, what's the wage for the employee, all those things. That payroll register is going to serve as a check register as well, which will list all the net pay amounts for all the employees up to date. And it's going to provide the information of the recording payroll expenses and the related withhold taxes that the employer has to submit. Now, again, put this in your mind. There's expenses for the employee, and there's withholding taxes. Withholding taxes are the one that employer holds from the employee earnings, and the payroll expenses are the one that employer has to pay to the government on top of the wages that he pays for the employee. Then we're going to have this payroll check, which payroll check is going to show gross earnings, deductions, current deductions, year-to-date deductions, deductions for the income tax, deductions for Canada Pension Plan, deductions for the employment insurance, accumulated accumulated not amortization, accumulated vacation, total deductions, deductions to date, and total pay, which is transferred to the bank account of the employee through the electronic fund transfer. How are we going to record the cash payment for the payroll? Most employer must record at least 3 cash payments. First one is to net pay for the employees, which will be the gross amount of the payroll less the deductions. Second will be that payment goes to the bank account for all the bank account and employees. Second payroll, so second check that they have to do is to submit the taxes to the government, the one that they're holding from the payroll and the one that they have to accrue as expenses. And the last payment is to the third parties for the employee benefits. That will be extended health, that can be work compensation, that will be now that we have the employee owes taxes for the employee health tax, which is for the BC Medical. So for those of you who are residents, not residents, sorry, holding PR or don't have or the one who working on the working visa, not a student visa, working visa. Once you move for the student visa, you don't have to pay anymore for BC Medical if you're not a Canadian citizen or if you're not a permanent resident. If you're international students, you have to pay medical, BC Medical. Once you finish with the school and you get working visa, you don't have to pay that anymore. Who pays it? Employer pays it. Earning records. Do we have to keep earning records for the average employee? Yes, we do. What will be the earning records? The earning records at the end of the year will gonna be submitted to the employee as a T4. All the T4s has to be filed and sent to the employee physically before February 28th, and that's a law in Canada. Before 28th, if the latest you can get it in March, due probably for the Canada Post. There's a delay on the Canada Post, so sometimes you can get it. More probably you're going to get it after in March, but it doesn't mean that the employer doesn't have to submit it before 28th. The latest the employer has to submit it is February 28th. That's the due date. So now internal control over the payroll. Obviously, there has to be control over the efficiency and safeguarding of the payroll disbursements as well. Control the efficiency, that will be how the calculation is performed. You have to print the payroll register and the payroll checks. Update the employee earnings records electronically. Every time when there's adjustment to the payroll, make sure that you put those adjustments and everything, the system is updated if you're running the internal system. How are we going to safeguard the payroll disbursements? Now, the large organization, they're going to establish some control to ensure that the payroll payments are made only to the legitimate employee and for the correct amount. I don't know if you know, maybe you don't, and you don't have to, but sometimes employers send payments for the payroll for the people that nobody knows, nobody sees in the company. They are on the payroll records, but again, nobody see them. Nobody knows where they are. So, How are we going to record the current liability? What is in current liability? Everything that company owes within 1 year or operating cycle, whichever is longer. So that will be accounts payable, salary payable, estimated warranty payable, current portion long-term debt, GST payable, interest payable, employee income tax payable, Canada pension plan payable, employment insurance payable, contingent liability if there's any, and any other liabilities if there are any. And then we're going to get the total. Second section of the liability will be long-term liability, which include a portion of the notes payable, which is over 1 year for current operating cycle of the company, and usually going to present at the net amount less the current portion of long-term debt. Where will be the current portion of long-term debt? Right here. You can see it. Current portion of the long-term debt, and that's deducted from the not payable. So not payable long-term liability. We're not showing $100,000. We're showing the net of the long-term debt, which is $90,000. What's the international financial reporting impact? That we're gonna leave it to my colleagues, which teach you intermediate financial reporting. And I'm gonna stop right here with the liabilities. Questions?